Here's a brief discussion on the DuPont analysis. The DuPont analysis is just another way of looking at two ratios that we've previously looked at, ROA and ROE. In essence, what we're going to do is we're going to decompose these ratios and look at different parts so that we can maybe get a better indication of what might be going on with the firm. The DuPont analysis was created in the 1920s from the scientists at DuPont. In addition, remember, this is an accounting equation. So before I go into the DuPont analysis, let me briefly go ahead and just make sure that we have a good understanding of what ROA and ROE are. Well, first of all, if we have revenues on an income statement, we subtract our expenses, we usually have some type of net income. So let's go ahead and put a number to this. Let's say that we have $100 in sales, and we subtract $90 in expenses, and we're left over with $10. That would be considered the return. Now let me go ahead and put a balance sheet here and say assets equals liabilities plus the owner's equity. What if our assets are $100, therefore our liabilities are $50 and our equity is $50? Well, what would be the ROA and ROA here? Well, ROA is a return. Here's a return on assets. So if we take a look at it, we have $10 on $100 worth of assets. So we returned 10%. That would be our ROA. And the way I did the math was I just took the $10 and divided by the total $100. So return based on assets. Now ROE would be return based on equity. So if $10 is the total return and I have a total of $50 in equity, that's a 20% return. I returned 20% of all my equity. And I just divided 10 by the 50. And the only way that ROA and ROE would ever equal would be if the firm has zero debt. So let's go ahead and take a look at ROA again, and let's do just like we just showed here and say, well, it is net income, which was here, and divided by the total assets. So that was ROA. What if I decided to leave net income on top and leave total assets on the bottom, but pull them apart and place a number here and here? Let's say that number is 1. If the number is 1, these two numbers together, if I divide 1 to this and 1 over this, multiply them together, I would get the exact same number. Oops, 2. If it was 2, we'd get the exact same number as well. So let's just go ahead and place some number maybe on the balance sheet. Let's go ahead and come over here and let's say, or the income statement, and let's put in revenue. Now if we look closely, what we've done here is we've taken two ratios that we've already looked at and multiplied them together and got ROA. So what is this one here? What is net income divided by sales? Well, that is your net profit margin. What is this one here? Well, if I take revenues and divide it by the total assets, that is your total asset turnover. So in essence, if I multiply total asset turnover times net profit margin, I will get ROA. So what does that tell me? Well, what if you have two firms and firm A has a really good net profit margin and firm B doesn't? However, firm B's total asset turnover, they manage their assets quite well, therefore their ROA is higher based on that, even though their net profit margin is lower. Is that good or bad? Well, it depends. It depends on the firm. Maybe being able to manage assets is better for that particular type of industry than having a net profit margin. I don't know, but it's good to decompose your ROA to see these two parts so that we get a better understanding of it, so we can look at the net profit margin and the total asset turnover, which basically is how many times profit margins is earning for that particular year, is another way of looking at it. Now let's look at ROE. ROE. And I'm going to use these same numbers right up here. Numbers, but I'm going to use the same right here. I'm going to come out and say net income divided by revenues, which again is your net profit margin. And I'm going to multiply it by your revenues divided by your total assets, which again now is your total asset turnover. That would give me ROA. Now, As I mentioned before, ROA and ROE would only be the same or equal if the company has no liabilities. As long as the company has liabilities, ROE is going to be a little higher. In addition, don't forget, these are accounting, not finance. Now, if I multiply a third by we call it the equity multiplier, which is total assets, divided by your common equity, I'll just equity, which is total assets, is right here, and your equity, common equity, is right here. I get something referred to as an equity multiplier. Now, the equity multiplier is kind of an adjustment factor. When I multiply the equity multiplier by these two numbers, I get ROE. And you can see that if these two numbers are the same, total assets and equity, let's say they were both 100, because we have no debt, this would be 1, therefore these two numbers would equate. And basically that is your DuPont analysis. The DuPont analysis, like I said, is just another way of looking at your return on assets and your return on equity, and we're decomposing, looking at its parts. And you got to remember what part here is making the ratio look better or worse depending on the company. If the net profit is making ROA a favorable number versus another company, is that good for that industry or not? Is it the total asset turnover that's making your ROA better, and is that reflective of the industry or not? So just another way of looking at ROA and ROE.